The US is in a technical recession. It's all there, black and white, clear as crystal. My question is, what do you think it's going to mean for the Fed calculus on raising rates? Morning to you, sir.
Good morning. I'm not sure it's going to make a huge difference. I think the Fed realizes that whether it's a recession today or it's going to be a recession in the second half of the year, there needed to be a material slowdown in the US economy to bring inflation under control. As at today, inflation is still up towards 10%. And so whether we had a technical recession in the first 2 quarters this year, we are going to have a material slowdown in order to bring this inflation number down.
Because the conversation up until now has been, given this negative GDP print, we could potentially see a slowing in the pace of hikes from the Fed. Perhaps that is a while away from eventuating. But Gary, do you think either way the markets are too sanguine on the future pace of Fed tightening?
They are too sanguine. While I might agree with Yellen that we've got every evidence at the moment that the US economy is somewhat robust. Labor market in particular has remained relatively strong. But if you have a strong labor market, you're going to have to have higher wage growth, and because otherwise consumers are going to lose a lot of spending power, and you're going to go into a recession. So one way or the other, I think the Fed is still very challenged by the inflation outlook. Interest rates will have to go higher at a good pace, and that is going to be damaging to the market certainly from these levels.
Okay, so my question is, how damaging is it going to be? We still have inflation tracking at 9.1% stateside. The Fed has a lot more work to do. We've already seen valuations coming down significantly in tech, for example, some of those darling sectors of Wall Street. Walk me through how bad this could be as the Fed continues on this rate hike trajectory in the second half.
Yeah, I think the kind of sanguine view is that the Fed increases interest rates for a couple of quarters, then can move sideways and everything corrects itself. We don't believe that the case. In order to bring inflation down from 9%, probably means that the Fed has to go above the kind of 3.25% that's currently priced in the market, maybe as high as 4%, in which case you could see US equities down 20% from here quite comfortably. And that, to us, doesn't even take us into materially cheap territory.
Okay, down 20%. That's a big call. Gary, how are you seeing earnings shape up as well? Because this is also going to play into valuations. The earnings parade has been well underway this week in the United States. How are you seeing inflation? And the other major factor, which I would say is probably the USD impacting corporate margins here. And what does it mean for valuations moving forward?
Yeah, I think everyone expected the second quarter just to give us the answer that, that things are slowing down, that there's some material drop in profitability, and this will be bad news to the market. It never is like that. Remember that, the peak of the equity market was in the first quarter of this year. It's going to take some time for the inflation to push through and damage corporate margins. So I don't think the second quarter is going to be the worst. I think it could be the back end of this year where we're going to see some material slowdown in corporate profits growth, if not outright downturn. And the dollar is going to be in the mix there as a big headwind to US corporate profitability. We've already seen that with some of the numbers which have shown a very weak international perspective, but domestically, some of these companies still achieving their targets. I think both will be working in tandem by the fourth quarter of this year, which, as I said, then brings us down to the kind of targets I have for the S&P of 20% lower.